Welcome. Brilliant to have you here. Now, if you've ever wondered about Forex trading but felt completely overwhelmed by the jargon and complexity, I can assure you you're in precisely the right place. This presentation represents a comprehensive mini-course designed to take you from absolute beginner to confident Forex trader. And I do mean absolute beginner. Whether you've never heard of a currency pair or you're simply looking to solidify your foundational knowledge, we're going to cover absolutely everything you need. Now, what makes Forex trading so fascinating? Well, it's the largest financial market in the world, truly global in scope. Every single day, trillions of dollars worth of currencies are exchanged across borders, from euros to pounds, dollars to yen, and everything in between. It's an extraordinary market that operates 24 hours a day, 5 days a week, following the sun around the globe. But here's the critical bit. Forex trading isn't just for banks and massive corporations anymore. With the right knowledge, discipline, and approach, individual traders like you and me can participate in this market and potentially profit from currency movements. Throughout this course, we're going to demystify everything. We'll explore what Forex actually is, how currency pairs work, the mechanics of making money through buying and selling, essential concepts like pips and lot sizes, the powerful but risky tool of leverage, risk management strategies that protect your capital, technical and fundamental analysis, trading psychology, and so much more. Now, I must be completely frank with you. Forex trading carries significant risk. This isn't a get-rich-quick scheme. Success requires education, practice, discipline, and a proper trading plan. But with the right approach and realistic expectations, it's entirely possible to develop genuine trading skills. So, let's embark on this journey together. Stay engaged, take notes, and remember, every expert trader started exactly where you are now. Let's dive in and discover the world of Forex trading.
Right then, let's dive straight into the fundamentals. What exactly is Forex? Forex, or FX as it's commonly abbreviated, stands for Foreign Exchange Market. It's the global marketplace where currencies are traded against one another. Now, when I say global, I mean truly global. This is the largest financial market in the world, with over $6.6 trillion traded every single day. Think about that for a moment. Trillions! It's the most liquid market on the planet. One of the most fascinating aspects of the Forex market is that it operates 24 hours a day, 5 days a week. It literally follows the sun around the world, from Sydney to Tokyo, London to New York. There's always a market open somewhere, which provides incredible flexibility for traders across all time zones. Now, here's a practical example that makes this concept crystal clear. You know when you're at the airport and you need to exchange your home currency for the currency of the country you're visiting? That's Forex in action. You're exchanging money from one currency to another at a quoted exchange rate. It's exactly what happens in the Forex market, just on a much larger, more sophisticated scale. In Forex, we trade what are called currency pairs. These represent the relative value between two currencies. For instance, if you see EUR/USD equals 1.1015, that means 1 euro costs $1.01. The first currency in the pair, in this case the euro, is called the base currency, and the second, the US dollar, is the quote currency. This exchange rate is constantly fluctuating based on supply and demand, economic conditions, geopolitical events, and countless other factors. And it's these fluctuations that create trading opportunities for Forex traders, like us. So there you have it. Forex is essentially the worldwide marketplace for currency exchange, operating around the clock with enormous liquidity and constant price movements. It's a dynamic, exciting market with tremendous potential.
Now, who exactly participates in this enormous Forex market? The answer is quite diverse and fascinating. First, we have retail traders. That's individuals like you and me.
everyday people who want to exchange currencies, whether for travel, investment purposes, or to generate income through trading. With the advent of online trading platforms and brokers, retail participation has grown tremendously over the past 2 decades. Then we have the banks, major commercial and investment banks. They're absolutely enormous participants in the Forex market. Banks exchange currencies on behalf of their clients, facilitate international transactions, and also engage in proprietary trading to generate profits. When you hear about the institutional market, banks are a huge part of that. Business owners and corporations are also significant players. Imagine a multinational company operating in 10 different countries, each with its own currency. The main office might be in the United States, requiring all revenues to be converted to US dollars. Every branch in a different country needs to exchange their local currency for dollars before sending funds to the head office. These corporate currency conversions represent substantial Forex volume. We also have governments and central banks participating. They manage national currency reserves, intervene to stabilize their currencies, and conduct monetary policy operations that directly impact exchange rates. And finally, there are hedge funds and institutional investors who trade currencies as part of their broader investment strategies, seeking to profit from currency movements or hedge against currency risk in their portfolios. So you see, the Forex market brings together this incredible mix of participants, from individual retail traders to massive multinational banks and governments. Everyone's in the same market, all trading the same currency pairs, creating this vibrant, liquid, 24-hour marketplace. And the beauty is, with proper education and the right approach, retail traders like us can participate alongside these institutional giants.
Let's now explore currency pairs and their different types. Understanding this structure is absolutely fundamental to Forex trading. First, the basic structure. Currency pairs are written as base/quote. The first currency, the base, is the one being bought or sold. The second currency, the quote, is the one being used to make that purchase. So, in Euro USD, if you're buying euros using US dollars. Now, currency pairs fall into 3 main categories. Let's examine each one. Major pairs are the most popular and liquid pairs in the Forex market. The defining characteristic? They always include the US dollar. Examples include Euro USD, Euro versus dollar, GBP USD, the British pound versus dollar, USD JPY, dollar versus Japanese yen, and AUD USD, the Australian dollar versus US dollar. These pairs have the tightest spreads, the most liquidity, and are generally recommended for beginners. Cross pairs, on the other hand, do not include the US dollar. Instead, they pair 2 major currencies together. For instance, Euro GBP, pairing the euro with the British pound, or GBP JPY, pairing the pound with the Japanese yen, or Euro AUD, pairing the euro with the Australian dollar. These can be excellent trading opportunities, but typically have slightly wider spreads than major pairs. Finally, we have exotic pairs. These pair a major currency, usually the US dollar, with a currency from an emerging or developing economy. Examples might include USD TRY, US dollar versus Turkish lira, or USD ZAR, dollar versus South African rand. Now, I must be frank with you, I strongly discourage beginners from trading exotic pairs. Why? They have much lower liquidity, significantly wider spreads, higher volatility, and can be prone to erratic price movements. They're simply too risky when you're learning. My recommendation? Stick with major pairs when you're starting out. Euro USD, GBP USD, USD JPY. Once you've gained experience and confidence, you can explore cross pairs. Leave exotics for much later in your trading journey, if at all.
Now we arrive at the question everyone wants answered. How exactly do you make money in Forex trading? The fundamental principle is beautifully simple. Buy low, sell high. or sell high, buy low. Let me explain both scenarios. If you predict that a currency pair will increase in value, you buy it at the current price and then sell it later at a higher price. The difference between your purchase price and selling price multiplied by your position size is your profit. For example, if you buy EUR/USD at 1.1000 and sell it at 1.1050, you've captured 50 pips of movement, and depending on your lot size, that translates to real monetary profit. Now, here's what confuses many beginners. In Forex, you can also profit when prices fall. If you predict a currency pair will decrease in value, you can sell it first. Yes, sell something you don't own, and then buy it back later at a lower price. This is called going short or shorting. The difference is still your profit. So if you sell GBP/USD at 1.3000 and buy it back at 1.2950, you've again captured 50 pips, this time from a downward move. In trading terminology, buying is also called going long or taking a long position. Selling is called going short or taking a short position. These terms are completely interchangeable. The key insight here is that Forex markets provide opportunities in both directions, upward and downward. Unlike traditional stock investing, where you typically only profit when prices rise, Forex traders can profit from both rising and falling currency values. We measure these price movements in pips, which we'll explore in detail next. And the difference in pips, combined with your position size, determines your actual profit or loss. The beauty of this system is its flexibility. Markets are constantly moving, constantly creating opportunities. Whether a currency is strengthening or weakening, skilled traders can identify opportunities and potentially profit. Of course, this also means risk exists in both directions, which is why proper risk management, which we'll cover thoroughly, is absolutely essential.
Let's now tackle pips, one of the most important concepts in Forex trading. What exactly is a pip? A pip stands for percentage in point or price interest point. It's the smallest standardized price movement in a currency pair, essentially the standard unit for measuring price changes in Forex. For most currency pairs, a pip is a change in the fourth decimal place. Let me give you a concrete example. If Euro/USD moves from 1.1014 to 1.1015, that's a 1 pip increase. Notice the fourth decimal place changed from 4 to 5. That's 1 pip of movement. Here's another example with USD/CHF, US dollar versus Swiss franc. If the price moves from 0.8552 to 0.8541, we need to analyze this carefully. The fourth decimal went from 2 to 1. That's a 1 pip decrease. But notice the third decimal also changed from 5 to 4. That third decimal represents 10 pips, so this is actually an 11 pip decrease in total. Now, there's one important exception you must remember: Japanese yen pairs. For any pair involving JPY, a pip is measured at the second decimal place, not the fourth. So for USD JPY, if the price moves from 142.50 to 142.80, that's a 3 pip increase. The second decimal place moved from 5 to 8, 3 full pips. Why does this matter so much? Because pips are how we measure profit and loss in Forex. When I say I captured 30 pips on that trade, I'm describing the price movement I profited from. When combined with lot size, which we'll discuss next, pip movement translates directly into monetary profit or loss. Now, the good news, you won't be manually counting pips during trading. Modern trading platforms calculate pip movements automatically and show you your profit or loss in real time.
but understanding what pips represent and how they're measured is fundamental knowledge every Forex trader must have. It's the language of the market.
Now, let's connect pips to actual money by understanding lot sizes and pip values. This is where theory meets practical reality. Lot size is the standard unit of measurement for position size in Forex trading. You can't simply say, I'm trading $1,000 worth. Different currencies have different values, so we use lot sizes as a universal measurement system. There are 4 tiers of lot sizes. A standard lot represents 100,000 units of the base currency. A mini lot is 10,000 units, or 0.1 of a standard lot. A micro lot is 1,000 units, or 0.01 of a standard lot. And a nano lot is 100 units, or 0.001 of a standard lot. Now here's the critical connection. The lot size you trade directly determines how much each pip movement is worth in monetary terms. This relationship is absolutely fundamental to understanding your risk and potential profit. Let's use Euro-USD as an example. For one standard lot, each pip of movement equals approximately $10. So, if price moves 50 pips in your favor with one standard lot, you've made $500. If you're trading one mini lot, 0.1 standard lot, each pip is worth $1, so 50 pips equals $50 profit. For a micro lot, 0.01, each pip is worth 10 cents, making 50 pips worth $5. Different currency pairs have slightly different pip values, but for major pairs, these figures are quite standard and easy to work with. Why is this so important? Because understanding lot sizes and pip values allows you to precisely control your risk. If you know each pip is worth $10 with your position size and you set a 50 pip stop loss, you know exactly that your maximum risk is $500. This precision is essential for proper risk management. Now don't worry about memorizing all these calculations. Modern trading platforms have position size calculators built in. You input your desired risk amount and stop-loss distance, and the calculator tells you exactly what lot size to trade. But understanding the underlying concept, how lot size determines pip value, and how that translates to monetary risk and reward, that's knowledge every serious trader must possess.
Now we need to discuss leverage, an incredibly powerful tool that can dramatically amplify both your profits and your losses. Listen carefully to this section, as leverage is where many beginners make catastrophic mistakes. Leverage is the ability to control a large amount of money using very little of your own capital. The broker essentially lends you the remainder. Leverage is expressed as a ratio, for example, 100 to 1, 50 to 1, or 30 to 1. Let me illustrate with a concrete example. Suppose you have $1,000 in your trading account, and your broker offers 100 to 1 leverage. This means that for every $1 of your capital, you can control $100 of trading power. So your $1,000 can control a position worth $100,000. Now here's where it gets critical. Let's compare 2 scenarios. With 100 to 1 leverage, your $1,000 becomes $100,000 of buying power. If you risk 1% on a trade and make 1% profit, you've made $1,000. You've doubled your account. Brilliant! But, and this is enormous, if you lose 1%, you've lost $1,000. Your entire account is wiped out. Finished. Now consider the same scenario without leverage, 1 to 1. You risk $1,000 at 1%, making or losing only $100 per trade. If you lose, you still have $900 left, much safer, but obviously much smaller profits. Here's my frank assessment.
Leverage is a double-edged sword. Yes, it can multiply your gains spectacularly, but it multiplies your losses with equal ferocity. Many beginners are seduced by the profit potential and ignore the catastrophic risk. High leverage is dangerous. It tempts traders to risk far too much, leading to blown accounts and devastating losses. My strong recommendation, especially for beginners, use low leverage or no leverage until you've proven consistent profitability. 30-to-1 or even 10-to-1 is far more prudent than 100-to-1 or higher. Remember, professional traders use leverage carefully and conservatively. It's amateurs who chase maximum leverage, and it's amateurs who suffer the consequences. Respect leverage, understand its risks, and use it judiciously. Your trading account and your financial future will thank you.
To actually participate in Forex trading, you need access to the market, and that access comes through Forex brokers. Let's examine what brokers are and the critical differences between regulated and unregulated brokers. Forex brokers are financial services companies that provide traders access to a platform for buying and selling currencies. They're the intermediary between you and the massive interbank Forex market. You deposit funds with the broker, use their trading platform, and execute your trades through their infrastructure. Now, this is absolutely crucial. Brokers fall into two categories, regulated and unregulated, and the difference is enormous. Regulated brokers are licensed and monitored by a regulatory authority. In the UK, that's the FCA, Financial Conduct Authority. In the United States, it's the CFTC and NFA. In Australia, it's ASIC. These regulators enforce strict standards, capital requirements, client fund segregation, transparent pricing, and dispute resolution mechanisms. The advantages of regulated brokers: safety and customer protection. Your funds are segregated from the broker's operating capital. There's oversight and accountability. If something goes wrong, you have recourse. The disadvantages? They typically offer lower leverage, often 30-to-1 or 50-to-1 maximum, fewer tradable instruments, and sometimes more stringent account opening requirements. But here's the critical risk: no regulatory oversight. There's potential for price manipulation, unfair trading conditions, difficulties withdrawing funds, and in worst cases, outright fraud. If the broker disappears with your money, you have virtually no recourse. My recommendation? Especially for beginners, absolutely use a regulated broker. Yes, the leverage is lower, but that's actually protective. Yes, there might be fewer exotic pairs, but you should be focusing on major pairs anyway. The safety, transparency, and customer protection are worth far more than higher leverage or exotic instruments. Your broker is your gateway to the market. Choose wisely, prioritize regulation and reputation, and never risk capital with a broker that isn't properly licensed. This decision is far too important to compromise on.
Just because the Forex market is open 24 hours a day doesn't mean you should be trading around the clock. Understanding trading sessions and optimal timing is essential for success. The Forex market operates 24 hours, 5 days a week, but it's divided into 4 major trading sessions based on the world's major financial centers: Sydney, Tokyo, London, and New York. The Sydney session opens at around 10 p.m. GMT and runs until 7 a.m. GMT. The Tokyo session runs from midnight to 9 a.m. GMT. The London session, absolutely massive, operates from 8 a.m. to 4 p.m. GMT. And the New York session runs from 1 p.m. to 10 p.m. GMT. Now, here's what you must understand. Not all trading sessions are created equal. Volume and volatility vary dramatically depending on which financial centers are active. The Sydney and Tokyo sessions tend to be quieter with lower volatility. Price action is often range-bound, moving sideways in a consolidation pattern. These sessions can be suitable for certain strategies, but they generally offer fewer clear trending opportunities. The London session is where things truly come alive. It's the largest Forex trading center globally, accounting for roughly 35% of daily Forex volume. Price movements become more decisive, volatility increases substantially, and trending behavior is more common. The New York session overlaps with London for several hours, and this overlap period, roughly 1 p.m. to 4 p.m. GMT, represents the absolute highest volume and liquidity period in the entire 24-hour cycle. Both London and New York traders are active simultaneously. Major economic data is often released, and price movements can be exceptionally dynamic. My strong recommendation, especially for beginners, focus on the London session and the London-New York overlap. This is when the market is most liquid, spreads are tightest, and trending opportunities are most pronounced. The Tokyo session can work for certain strategies, but it requires different techniques suited to range-bound markets. Don't fall into the trap of trying to trade every session. Quality over quantity. Focus on the times when the market offers the best conditions for your strategy. Trade those sessions with discipline and use the remaining hours for analysis, planning, and rest. Trading is a marathon, not a sprint, and timing your participation intelligently is a key competitive advantage.
News events and economic fundamentals can create dramatic, sudden price movements in the Forex market. Understanding how to track and respond to these events is absolutely essential. High-impact news releases, such as central bank interest rate decisions, employment reports, GDP figures, and inflation data can cause currency pairs to spike violently, sometimes moving 100 pips or more in mere seconds. These aren't gradual movements. They're explosive, volatile reactions as the market digests new information and reprices currencies accordingly. For Forex traders, awareness of upcoming news events is not optional. It's mandatory. You must know when major announcements are scheduled so you can prepare appropriately, whether that means closing positions before the news, staying flat during high-risk periods, or positioning yourself to capitalize on the volatility if that's your strategy. The essential tool for tracking news events is an economic calendar, and the best free resource is forexfactory.com. Let me walk you through how to use it. Navigate to Forex Factory's calendar section. You'll see a week-by-week schedule of economic events from around the world. Each event is color-coded by impact level. Red for high-impact events that are likely to cause significant volatility, orange for medium impact, and yellow for low impact. You can filter by currency. For example, if you only trade EUR USD and GBP USD, filter to show only USD, EUR, and GBP events, eliminating irrelevant noise. You can also adjust the time zone to your local time, ensuring you know exactly when events occur in your schedule. For each event, Forex Factory shows the previous result, the market forecast, and after release, the actual figure. The deviation between forecast and actual is what drives market reactions. If the forecast was positive, but the actual is negative, expect sharp price movements. My recommendation, check the economic calendar every single day, ideally at the start of your trading day. Mark high-impact events in your planner. Avoid trading major pairs 5 to 10 minutes before and after high-impact releases unless you specifically have a news trading strategy, which I don't recommend for beginners due to the extreme risk and volatility. Concluding with insight. Fundamental analysis, understanding economic conditions, central bank policies, geopolitical developments, provides crucial context for technical analysis. While I primarily rely on technical analysis for trade execution, I always keep an eye on fundamentals. Ignoring major news events is a recipe for disaster. Stay informed, stay aware, and never let a surprise news release catch you off guard.
Let me guide you through the industry-standard tools and an effective workflow for executing trades and analyzing the market. The execution platform choice for most Forex traders is MetaTrader, available in two versions, MetaTrader 4, also known as MT4, and MetaTrader 5, or MT5. These are industry-standard platforms provided by most Forex brokers. You download the software, available for Windows, Mac, and mobile devices, log in with your broker-provided credentials, and you're ready to trade. MT4 and MT5 allow you to execute trades, set stop losses and take profit levels, view real-time price charts, monitor open positions, and manage your account. They're functional, reliable, and universally available. However, I must be frank, their charting and analysis tools, while adequate, aren't the most elegant or user-friendly. That's where TradingView comes in. TradingView is a web-based charting platform, absolutely brilliant for technical analysis. It offers superior charting capabilities, a vast library of indicators and drawing tools, clean interface design, cloud-based chart saving, and an active community sharing trading ideas. My personal workflow, and I recommend this highly, is to use TradingView for analysis and MT4 or MT5 for execution. Here's how it works. I conduct all my chart analysis on TradingView, identifying support and resistance, drawing trend lines, analyzing patterns, and marking potential entry and exit points. Once I've identified a trade setup, I switch to MT4, execute the trade with precise lot size, set my stop loss and take profit, and then return to TradingView to monitor price action and refine my analysis. This two-platform approach gives you the best of both worlds. TradingView's superior analysis tools combined with MT4's reliable execution capabilities. Both TradingView and MetaTrader offer free versions. TradingView has premium subscriptions with additional features, but the free version is perfectly adequate for beginners. MetaTrader is always free, provided by your broker. Here's my recommendation. Download MT4 or MT5 from your broker's website. Open a demo account to practice and simultaneously create a free TradingView account. Spend time familiarizing yourself with both platforms. Learn how to place trades, set stop losses, adjust lot sizes in MT4. Learn how to draw on charts, add indicators, and save your analysis in TradingView. Competence with your tools is foundational. You can't trade effectively if you're fumbling with the platform. Master your tools first, then focus on mastering the market.
Now we arrive at what I consider the single most important topic in this entire course, risk management. Listen very carefully because this is where most traders fail, and it's where disciplined traders succeed. Risk management is not optional. It's not something you implement eventually. It's the foundation upon which sustainable trading is built. Without proper risk management, you could lose all your money in one trade, or several trades, regardless of how brilliant your analysis might be. Here's the golden rule. Your maximum risk per trade should be between 0.5% and 2% of your total account balance. Let me emphasize, maximum 2%. If you have a $1,000 account, you should never risk more than $20 on a single trade. If you have $10,000, never more than $200. Why is this so critical? Because Forex trading involves uncertainty. No matter how experienced you become, losses are inevitable. Even the best traders have win rates of 50 to 60%, meaning they lose 40 to 50% of the time.
If you risk 10% per trade and lose 3 times in a row, you've lost nearly 30% of your account. Recovery from that is psychologically and mathematically difficult. Assuredly, but if you risk 1% per trade and lose 10 times in a row, which is statistically rare with a sound strategy, you've only lost 10%. You still have 90% of your capital intact. You can continue trading, continue learning, continue improving. Here's how to implement this practically. Before every trade, calculate your stop-loss distance in pips. Then use a position size calculator, available free on websites like MyFXBook or Baby Pips, to determine exactly what lot size you should trade to risk only your predetermined amount. For example, if you want to risk $20 on a trade with a 50 pip stop loss on EUR/USD, the calculator tells you to trade 0.04 lots, a micro lot. You enter that exact lot size, place your trade, set your stop loss, and you know with absolute certainty that if the trade goes against you, you'll lose exactly $20. No more, no surprises. Never, ever trade without a stop loss. I've heard countless traders say, "I'll just watch the screen and close manually." That's gambling, not trading. Emotional decisions in the heat of the moment lead to catastrophic losses. Set your stop loss when you enter the trade and honor it absolutely. Concluding warmly, risk management is the difference between a brief, expensive gambling hobby and a potentially profitable, sustainable trading career. Master this concept, implement it religiously, and you've already placed yourself ahead of 90% of failed traders.
Understanding reward-to-risk ratios and their relationship to win rate is essential for evaluating whether your trading strategy is mathematically viable. Let me break this down clearly. The reward-to-risk ratio, often written as R-R, compares your potential profit to your potential loss on each trade. A 1-to-1 ratio means you're risking $1 to potentially make $1. A 2-to-1 ratio means you're risking $1 to potentially make $2. A 3-to-1 ratio means risking $1 to potentially make $3. Now, here's where mathematics becomes your friend. Your reward-to-risk ratio and your win rate, the percentage of trades you win, work together to determine whether you're profitable overall. Let's examine 3 scenarios. With a 1-to-1 reward-to-risk ratio, you need to win at least 50% of your trades to break even. If you win 60% of the time, you're profitable, but not spectacularly so. This ratio offers little margin for error. With a 2-to-1 ratio, my recommendation for beginners, you only need to win 40% of your trades to be profitable. Even with a 50% win rate, you're solidly in profit. This gives you breathing room, cushioning against inevitable losing streaks. With a 3-to-1 ratio, you only need to win 33% of trades to break even, and anything above that is profitable. However, 3-to-1 trades are harder to find. They require price to move significantly further in your favor, which doesn't always happen. Let me illustrate with concrete numbers. Imagine 10 trades with a 2-to-1 ratio, risking $10 per trade. You win 5 trades, making $20 each. That's $100 profit. You lose 5 trades, losing $10 each. That's $50 in losses. Your net profit is $50 from a 50% win rate. That's the power of a favorable reward-to-risk ratio. Now compare that to a 1-to-1 ratio with the same 50% win rate. You win 5 trades at $10 each, $50 profit. You lose 5 trades at $10 each, $50 loss. You break even. You did all that work for nothing. Here's my guidance. Aim for a minimum 2-to-1 reward-to-risk ratio. It provides mathematical advantage, psychological comfort, and sustainable profitability even with moderate win rates. To implement this, when analyzing a trade setup, identify your entry price, your stop-loss level, and your take-profit target. Measure the distance from entry to stop-loss, that's your risk. Measure the distance from entry to take-profit, that's your reward. Only take the trade if the reward is at least double the risk. This disciplined approach, combined with the risk management we discussed earlier, creates a powerful framework for long-term success. You're not gambling,
You're implementing a mathematically sound system where the odds are systematically in your favor.
Let's delve into technical analysis, the key method most Forex traders utilize to spot trading opportunities. Technical analysis involves the study of past price movements on charts to predict future behavior. The fundamental idea is that price action encapsulates all available information. Every buyer's and seller's judgment about value is reflected through the price visible on the chart. By analyzing patterns, trends, support and resistance levels, and various indicators, technical analysts strive to foresee the next price direction. Technical analysis offers a multitude of tools and methodologies. Let's outline the significant categories, shall we? Trend lines and chart patterns are essential. Drawing trend lines to spot uptrends, downtrends, and sideways consolidation gives directional context. Recognizing patterns like head and shoulders, double tops, triangles, and flags can signal possible reversals or continuations. Technical indicators, mathematical calculations based on price and volume, assist in identifying momentum, trend strength, and possible reversal points. Popular indicators include moving averages, which smooth price data to reveal trends, the MACD, which identifies momentum shifts, and the RSI, which gauges overbought and oversold conditions. Support and resistance levels signify price zones where buying or selling pressure has historically been robust. Identifying these levels aids traders in anticipating where price might reverse or consolidate. Authoritatively speaking, price action trading centers purely on the price movement itself, evaluating candlestick patterns, market structure, and order flow without relying on indicators. Many professional traders favor this approach for its simplicity and directness. With warmth and wisdom, more advanced methodologies encase supply and demand zones, pinpointing institutional buying and selling areas, smart money concepts, tracing institutional trader behavior, ICT concepts, focusing on market manipulation and liquidity, and Elliott wave theory, analyzing market cycles through wave patterns. Now, here's my candid advice. Avoid aiming to master everything. The sheer vastness of technical analysis tools can be daunting, even paralyzing. Many beginners leap from method to method, never attaining competence in any singular approach. Instead, choose one methodology that resonates with you. Begin simply, perhaps trend lines, support and resistance, and one or two indicators like moving averages. Study it comprehensively. Practice it extensively. Backtest to verify its effectiveness. Once you've reached consistent proficiency, then and only then consider widening your toolkit. Technical analysis is a skill, and like any skill, it demands focused practice. Avoid spreading yourself thin. Dive deep, not wide. Master one approach, confirm it works for you, and build from there. That's the path to authentic competence and lasting profitability. While technical analysis examines price charts, fundamental analysis examines the underlying economic factors driving currency values. Understanding fundamentals provides crucial context for technical trading decisions. Fundamental analysis in Forex focuses on economic data, central bank policies, and geopolitical events, the macro forces that determine currency strength or weakness. Economic data reports are regularly released by governments and agencies. Key reports include GDP, gross domestic product, which measures economic growth, employment data, such as non-farm payrolls in the United States, which indicate labor market health, inflation figures like CPI, Consumer Price Index, and PPI, Producer Price Index, which track price level changes, retail sales, which measure consumer spending, and manufacturing indices like PMI, Purchasing Managers Index, which gauge industrial activity. When economic data comes in stronger than expected, the currency typically strengthens. Conversely, when data disappoints, the currency weakens. These reactions can be immediate and dramatic, which is why traders must be aware of scheduled data releases. Central bank policies are perhaps the most influential fundamental factor. Central banks, like the Federal Reserve in the US, the European Central Bank, and the Bank of England, set interest rates and conduct monetary policy. Interest rate decisions directly impact currency values. Generally, higher interest rates attract foreign investment, strengthening the currency. Lower rates have the opposite effect. Central bank communication, through policy statements, press conferences, and speeches, provides insights into future policy direction. Traders analyze this forward guidance to anticipate rate changes and adjust positions accordingly. For instance, if technical analysis shows a perfect setup to buy GBP USD, but you know that in 30 minutes there's a Bank of England interest rate decision, waiting until after the news is prudent. The technical setup might still be there afterward, but you've avoided the explosive, unpredictable volatility that news creates. Fundamental analysis and technical analysis aren't opposing philosophies, they're complementary tools. Fundamentals explain why price moves, technicals help identify when and where to enter and exit. Used together, they provide a more complete picture of the market, enhancing your decision-making and risk management.
Before you risk a single pound or dollar of real money on a trading strategy, you must backtest it. Backtesting is the process of applying your trading rules to historical price data to see whether the strategy would have been profitable in the past. Think of backtesting as a laboratory experiment for your trading strategy. Would this approach have worked over the past year, 2 years, 5 years? How many trades would it have generated? What would the win rate have been? What about the reward-to-risk ratio? Maximum drawdown? These are questions backtesting answers. Here's the systematic process. First, define your trading rules precisely. Entry criteria. What specific conditions must be present for you to enter a trade? Exit criteria. Where's your take profit? Where's your stop loss? Risk management. How much are you risking per trade? Every rule must be explicit and unambiguous. Second, select a representative time period for testing. Ideally, at least 1 year, encompassing different market conditions, trends, ranges, high volatility, low volatility. This ensures your strategy isn't just profitable in one specific market environment. Third, manually or automatically apply your rules to historical charts. For every instance where your entry criteria are met, record the trade, entry price, stop loss, take profit, outcome, pips gained or lost. Do this for dozens, ideally hundreds of theoretical trades. Fourth, analyze the results. Calculate your total win rate, average reward-to-risk ratio, total pips gained, maximum consecutive losses, and maximum drawdown, the largest peak-to-trough decline. These statistics reveal whether your strategy has an edge. Finally, if results are positive, forward test on a demo account. Apply the same rules in real-time market conditions without risking real money. This validates that you can execute the strategy consistently and that it still performs well in live conditions. Tools for backtesting include FX Replay, which allows you to replay historical price data candle by candle, manually executing trades as if trading live. TradingView offers a premium feature called Replay Mode with similar functionality. Some traders use trading journals with screenshots to document historical setups and outcomes. Now, why is backtesting so crucial? Because it provides evidence. Without backtesting, you're trading based on hope, intuition, or someone else's claims. With backtesting, you have data proving your strategy works, or proving it doesn't, which is equally valuable information. Backtesting also builds confidence. When you encounter inevitable losing streaks in live trading, and you will, your backtest data reminds you that losses are part of the statistical distribution. You're not panicking, you're experiencing normal variance within a profitable system. Never skip this step.
prove your strategy works before risking real capital. Backtesting is the difference between systematic trading and expensive guesswork.
A trading plan is your comprehensive guide for how you'll approach the markets. It's not merely a list of entry signals, it's a complete framework covering strategy, risk management, psychology, and operational procedures. Without a trading plan, you're improvising, making it up as you go. With a plan, you're executing a systematic approach. Let me outline the essential components of a robust trading plan. First, strategy and setups. Define precisely what trading methodology you're using. Trend following, mean reversion, breakout trading, whatever you've chosen. Document your exact entry criteria. What chart patterns, indicator readings, or price action signals must be present for you to enter a trade? Specify your exit criteria. Take profit targets, stop-loss placement, and trailing stop rules, if applicable. Second, risk management parameters. State your maximum risk per trade, 1%, 0.5%, 2%, whatever you've determined. Define your maximum daily or weekly loss limits, the point where you stop trading for the day or week to prevent emotional revenge trading. Specify your position sizing method, how you'll calculate lot sizes based on stop-loss distance and account size. Third, currency pairs and time frames. Which pairs will you trade? Major pairs only? Include crosses? Avoid exotics? What time frames will you use for analysis and execution? 15-minute charts, 1 hour, daily. Clarity here prevents random, unfocused trading. Fourth, trading schedule and sessions. Which Forex sessions will you trade? London, New York, both? What times are you available? When will you conduct analysis versus execution? Structure prevents overtrading and provides work-life balance. Fifth, record keeping and review. Commit to maintaining a trading journal, recording every trade with screenshots, rationale, outcome, and emotional state. Schedule regular reviews, weekly or monthly, to analyze performance, identify patterns, and adjust your approach based on data. Sixth, psychological rules and triggers. Acknowledge your emotional tendencies. If you're prone to revenge trading after losses, write a rule. After 2 consecutive losses, step away for 2 hours. If you overtrade when bored, write maximum 3 trades per day regardless of setups. Pre-committing to these rules prevents emotional hijacking. Creating a trading plan requires time and thought. It's not a 10-minute exercise. It's potentially several hours of reflection, writing, and refinement. But the investment pays enormous dividends. When market conditions become challenging, when emotions run high, when uncertainty clouds judgment, your trading plan is your anchor, keeping you grounded in predetermined, rational rules. A trading plan transforms you from a reactive gambler into a systematic trader. It's the written contract you make with yourself about how you'll conduct your trading business. Create it, honor it, refine it as you gain experience. This document is one of your most valuable trading assets.
Trading psychology is perhaps the most underestimated yet most critical factor in trading success. You can have the best strategy, perfect risk management, and years of experience, but if you can't control your emotions, you'll sabotage yourself repeatedly. Let me be direct. Trading exposes every psychological weakness you have. Fear, greed, impatience, overconfidence, revenge, regret. All these emotions surface with amplified intensity when your money is on the line. Markets are a ruthless psychological mirror. The most common psychological traps include fear of missing out, FOMO, which drives traders to chase price, entering trades impulsively without proper setups. There's revenge trading, where after a loss, traders immediately re-enter the market trying to win back their money,
typically with larger position sizes and lower standards, leading to even bigger losses. Overtrading is another trap. Taking too many trades out of boredom, impatience, or desperation, rather than waiting for high-probability setups. There's also fear of pulling the trigger, where after several losses, traders become paralyzed, unable to execute even when perfect setups appear, missing opportunities due to psychological hesitation. Then there's moving stop losses. The plan was to risk $20, but when price approaches the stop loss, emotion says, just give it a bit more room, moving the stop further away. Price continues against you, and suddenly you've lost $50 or $100 instead of the planned $20. This is catastrophic to both account balance and confidence. So how do we master trading psychology? Several strategies are essential. First, follow your trading plan religiously. Your plan was created when you were calm and rational. Trust it. In the heat of the moment, emotions will scream at you to deviate from it. The plan is your defense against that emotional noise. Second, accept losses as part of the process. Losses aren't failures, they're statistical outcomes within a probabilistic system. Even the best strategies lose 40 to 50% of the time. Reframe losses as the cost of doing business, like rent for a shop. Third, practice mindfulness and emotional awareness. Before executing a trade, pause and ask yourself, am I calm and rational, or am I emotional? Am I following my plan, or am I reacting impulsively? This simple pause can prevent countless disastrous trades. Fourth, take breaks after losses. Step away from the screen. Go for a walk. Reset emotionally before returning. Trading while emotionally charged is gambling, not trading. Fifth, focus on process, not outcomes. You can't control whether an individual trade wins or loses, too many random variables, but you can control whether you followed your plan, managed your risk properly, and executed with discipline. Judge yourself on process, not results. Finally, start small. Begin with micro lots, risking tiny amounts. As you prove psychological discipline, following rules, managing emotions, sticking to your plan, gradually increase position sizes. Psychological muscles must be trained just like physical muscles. Trading psychology isn't soft science, it's the hardest part of trading. Technical analysis can be learned in months. Risk management is straightforward mathematics. But mastering your mind? That's a lifelong journey. Commit to it seriously, because psychological discipline is often the only difference between profitable traders and failed ones.
Before you proceed further, I must issue several critical warnings. Forex trading is high risk, and I would be doing you a tremendous disservice if I didn't emphasize these realities. First and foremost, Forex trading carries substantial financial risk. You can lose some or all of your invested capital. This isn't a theoretical possibility, it's a statistical reality for most beginners. If you're trading money you can't afford to lose, money needed for rent, food, bills, or education, stop immediately. Only trade with risk capital, money whose loss would not materially affect your life. Second, there are no shortcuts to success. I've watched countless beginners search desperately for the holy grail strategy, the magical indicator, or the secret system that generates effortless profits. They jump from course to course, strategy to strategy, never committing to mastering any single approach. Let me be clear, sustainable trading success requires education, practice, discipline, experience, and time. There's no way around this. If someone promises you easy money or guaranteed returns, they're lying, either to you or to themselves. Third, you cannot succeed by blindly following other traders. Yes, mentorship can accelerate learning. Yes, studying successful traders provides insights.
But ultimately, you must develop your own understanding, your own strategy, your own discipline. Dependency on someone else's signals or analysis is a recipe for failure. You need to be your own trader. Fourth, regulated brokers are strongly recommended. Yes, unregulated brokers might offer higher leverage and more instruments, but the risks, manipulation, withdrawal problems, outright fraud, are simply not worth it. Safety and transparency should be your priorities, especially as a beginner. Use brokers regulated by the FCA, CFTC, ASIC, or equivalent authorities. Fifth, without a trading plan and proper risk management, you're gambling, not trading. If you enter the market impulsively, risking arbitrary amounts, moving stop losses emotionally, you will lose money, perhaps not immediately, but inevitably. Trading without structure is financial self-destruction. Sixth, demo trading before live trading is non-negotiable. Yes, demo trading lacks the emotional intensity of risking real money, but it allows you to learn platforms, test strategies, and make mistakes without financial consequences. Only transition to live trading with micro lots after proving consistent profitability on demo accounts. Finally, managing expectations is crucial. Forex trading is not a get-rich-quick scheme. It's a skill-based endeavor requiring dedication comparable to learning a musical instrument or a new language. Expect months, even years of learning before achieving consistent profitability. View initial capital as tuition, money invested in your education, not money you'll immediately multiply. These warnings aren't meant to discourage you, they're meant to protect you. Approach Forex trading with seriousness, respect for risk, commitment to education, and realistic expectations. This mindset separates those who eventually succeed from those who suffer painful, expensive failures.
You've absorbed a tremendous amount of information throughout this course. Now comes the practical question. What's next? How do you actually begin your Forex trading journey? Let me provide a clear, actionable roadmap. Step 1. Open a demo account. Visit a regulated broker's website, research options based on your region, and open a free demo account. This gives you access to their trading platform with virtual money, allowing risk-free practice. Download MetaTrader 4 or 5, log in with your demo credentials, and familiarize yourself with the interface. Learn how to place trades, set stop losses, adjust lot sizes, and navigate the platform comfortably. Step 2. Study one trading methodology deeply. Don't scatter your focus across 10 different strategies. Choose one approach, perhaps price action, or trend lines and moving averages, and commit to understanding it thoroughly. Read articles, watch educational videos, study chart examples. Aim for depth, not breadth. Step 3. Backtest your chosen strategy rigorously. Apply your trading rules to historical charts. Record dozens, ideally hundreds of theoretical trades. Calculate win rate, reward to risk ratio, maximum drawdown. Does the strategy have a positive expectancy? If not, refine it or choose a different approach. If yes, you've identified a potential edge. Step 4. Practice on demo with discipline. Apply your strategy in real-time demo trading. Treat it seriously. Execute your rules exactly as written. Manage risk properly. Maintain a trading journal. Aim for at least 2 to 3 months of consistent demo performance before considering live trading. Step 5. Create a comprehensive trading plan. Document your strategy, risk management rules, trading schedule, psychological guidelines, and review procedures. This plan becomes your operational manual. Step 6. Study risk management and trading psychology continuously. These topics deserve ongoing attention. Read books, listen to podcasts, engage with trader communities. Psychological mastery is a journey, not a destination. Step 7. Transition to live trading with micro lots. Once demo performance is consistently positive, not perfect, but consistently following rules and managing risk, open a small live account. Start with the absolute minimum deposit and trade micro lots, risking tiny amounts. This introduces real emotional stakes while limiting financial exposure. Step 8. Maintain your trading journal religiously. Record every live trade, screenshot, rationale, outcome, emotional state. Review weekly. This journal is your most valuable feedback mechanism, revealing patterns, strengths, and weaknesses. Step 9. Be patient and persistent. Expect setbacks, expect frustration, expect periods where nothing seems to work. This is normal. Every successful trader has endured these challenges. The difference is they persisted through difficulty, learned from mistakes, and continually refined their approach. This roadmap isn't fast and it isn't easy, but it's realistic, systematic, and protective of your capital. Follow these steps with discipline and patience, and you'll give yourself the best possible chance of joining the minority of traders who achieve consistent profitability. The journey begins with your very next action. What will you do first?
We've reached the conclusion of this comprehensive Forex trading course. Let's consolidate the most critical insights you must carry forward. Forex is the largest financial market in the world, operating 24 hours a day, 5 days a week, with over $6 trillion traded daily. It's a global marketplace where currencies are exchanged, and with proper knowledge and discipline, individual traders can participate and potentially profit. Currency pairs, major, cross, and exotic, represent the instruments we trade. Focus on major pairs as a beginner: Euro-USD, GBP-USD, USD-JPY. They offer the best liquidity, tightest spreads, and most predictable behavior. You make money by correctly predicting currency price movements, buying low and selling high, or selling high and buying low. Profits and losses are measured in pips, with position size determined by lot sizes. This system allows precise risk control. Leverage is a double-edged sword. It amplifies both profits and losses dramatically. Use it conservatively, especially as a beginner. High leverage is dangerous. It's the primary reason most traders blow their accounts. Risk management is non-negotiable. Risk only 0.5 to 2% of your account per trade. Use position size calculators. Always set stop losses. This discipline protects your capital and extends your trading lifespan, allowing you to learn and improve without catastrophic losses. Reward-to-risk ratios determine mathematical viability. Aim for minimum 2-to-1 ratios. This provides profitability even with modest win rates, creating systematic advantage. Technical analysis provides the tools for identifying trading opportunities: charts, patterns, indicators, price action. Choose one methodology, master it thoroughly, and prove it works through backtesting before risking real money. Fundamental awareness is essential. Know when major economic data releases are scheduled. Understand central bank policy's impact on currencies. Don't trade blindly into high-impact news events. Backtesting validates your strategy. Apply your rules to historical data, analyze results objectively, and forward test on demo accounts. Evidence-based trading beats hope-based gambling every time. A trading plan is your operational manual. Strategy, risk management, schedule, psychological rules. Create it, honor it, refine it. It's your defense against emotional decision-making. Trading psychology is the hardest part of trading. Master your emotions. Accept losses as statistical outcomes. Follow your plan regardless of feelings and focus on process rather than individual results. Psychological discipline separates winners from losers. And finally, maintain realistic expectations. Forex trading is not a get-rich-quick scheme. It's a skill requiring education, practice, discipline, and time. Expect months or years of learning. Treat initial capital as tuition. Be patient, persistent, and committed to continuous improvement. You now possess foundational knowledge covering every essential aspect of Forex trading. But knowledge alone isn't enough. You must apply it. Open that demo account. Study your chosen methodology. Practice with discipline. Create your trading plan. Master risk management. Build psychological resilience. The journey from beginner to consistently profitable trader is challenging, but it's absolutely achievable with the right approach. Thousands have walked this path successfully, and with dedication, you can too. Thank you for your attention throughout this course. I wish you tremendous success on your Forex trading journey. Remember, trade smart, manage risk religiously, and never stop learning. Best of luck.
Thanks so much for watching today's video. I really appreciate you taking the time to tune in. It means the world to me. If you enjoyed it, make sure to follow me across all platforms so you don't miss future content. And remember to like and subscribe, as well as leaving your questions and comments, as they are invaluable for future content ideas and refinement. Down in the description, you'll find links to the brokers I personally use, some backtesting software I recommend, and of course, our free Discord community where you can connect and learn alongside other traders. I'll leave you with one of my favorite verses. Be still and know that I am God. Psalm 46, verse 10. When you slow down and trust Him, peace follows. And as always, remember, strive for progress, not perfection. I'll see you all in the next one. God bless.